It's our Tuesday. Today, one of our clients mentioned to me that they want to understand financial statement because what happened is they were going through a IRS audit, and the IRS auditor actually came up to them and said that based on your financial statement that you presented, and we need to increase your income by 1.5 million. So that is the statement was made by the auditor. And the reason they made that statement, it has a good cause, has a good reason. It's not just they wanted to raise your taxable income. So it is really related to how you understand your financial statement. So it's two-part series. Today we're going to do part one. The part one, what we do is to literally just explain to you debit and credit. But I promise you that the way I do financial statement explanation, it would not be like university teaching. It is not what you learn from some sort of small business, startup seminars, webinars, and I am giving you a visual. I promise you that if you follow me through today for 20 minutes and you understand financial statement back in your mind like a clock, you will know what makes up the three pieces on the income statement, what makes up the three pieces in the balance sheet, and I'll make sense for you. And never mind about cash flow statement, that's another piece of financial statement, right? But if you know how to do income statement, you know how to understand the balance sheet, you would have your cash flow right on your fingertips. So it's not difficult at all. So now let's get going with what I want to talk to you about. And always before the knowledge exchange, we like to brag about our company, what we do, how we do it. And this is our website, right? You know how to get to our website, communitycpa.com, and you on here you can actually become our client without even bother to talk to us. You can go to on board with us, and there you sign yourself in, then you can upload your information and we'll receive your information, then work start to flow. And I will just tell you that we have a client used onboarding with us, uploaded information, we requested more, they give us more, and today we're coming up with a claim that we did for him is we'll get about $27,000 back for him from IRS. So look at that. It is, it's not about you, your taxes and your histories is the past, and don't touch it, because when you come to a firm like Community CPA, we make sure that what belongs to you is yours. That is kind of how we do business, and we want you to know that. Appointment button are the partners in the firm. We all have our name and area of expertise on there. You can select any one of us and meet us on video, so you will see our calendar and everything. So I just want to mention that. And of course, all of the stuff we talk about today, like before, it is all on YouTube channel. We have a Community CPA YouTube channel where you can go in. There's more than 1,300 videos from the past, and you can go to the magnified glasses, type in retirement, all the webinars related to retirement will come up. Type into estate will come up. Type into 1040, tax return would come up. So we talk about things just like how we talk about financial statement today. So this slide is about our firm. I'll just slide that by. And this is the two books I wrote. I got someone emailed me yesterday saying that he's the owner of these two books and he has questions for me. So I'm so proud of you, and I'm so glad that you got my book. And these books are not supposed to be boring. It really should be something making you interested, because you're gonna find people just like you in my book. Now let's go to the content today. Financial statement. So income statement plus balance sheet plus cash flow statement is called a financial statement. If someone says that, hey, want to see your company's financial statement, they're literally saying that they want these three statements. So now let's talk about these three. Today we're going to hit on something that how these three come about, like how easy are they for you to understand how they laid out. Then our part two, what I want to do is I want to tell you the function of each pieces. So if you apply for bank loan, what do you see on those statements? If you apply, if you are wanting to know whether you have money or not on your bank account, what statement you look and how you look. And if you are being audited by IRS, and what are the things you want to be sensitive about. So I will talk about that on part two. But on part one, I want to get the concept correctly done, right? So what is a profit and loss statement? Of course you know that, right? You know, most of our business people, we know how to read profit and loss statement. You got your sales, you got your expense, and you got your net profit. That's all. And there's not much of science to it other than on the expense side, you have a cost of goods sold is related to inventory. Then you also have your depreciation somewhat related to your balance sheet. So other than those kind of complications, you really are pretty straightforward. And income, you know what is your income, right? So you have your income, you have your expenses, you have your profit. So with that said, and really it's not a hard concept. But you may ask, oh, Ying, you know, people talk about debit and credit. I'm so confused with that. So on the income statement, which part is credit? Which part is debit? That's what they're asking, right? So on income statement, the top part, the sales, the revenue, that's the credit part. The expense side of it is a debit part, okay? And I will draw something for you soon, and just follow me. On income statement, here I further explaining cost of goods sold, expenses, revenues, but I will come to talk to you more about that. So when you talk about income, the income that you made, we want you to kind of understand that the income depends on your accounting method. That income number could be a different number, even though we're running the same business. We're running the same business, same income, but because I am on cash method, you're on accrual method, our income number can be different, right? So know that accounting method plays a key role to it, but today we're not going to tackle that. What we are tackling today is to make you understand the relationship between income statement and the balance sheet. So now let's look at the balance sheet. The balance sheet is also a financial statement part. It is one body of the financial statement. The big character difference between balance sheet and income statement is that income statement tells you a period, right? You want to know, oh, in this year, whether I made money or not. So you're talking about January the 1st to December 31st this year, how much profit you're making. But when you talk about balance sheet, it is the point of time. It is on December 31st, 2024, what do I look like? So it is a picture. It is a picture, but your income statement is a video. Make sense? But of course, the income statement video, at the very end, someone is laughing. That smiling face will come to the balance sheet. So income statement is a video. Balance sheet is a picture. So that's how you're going to remember that, right? All right, so then balance sheet also have asset, liability, equity side of things. So we're going to talk about that in my chart. Then cash flow. So what is cash flow? And I want to make that really easy for our business, small business owners. Our cash flow, if you have under $1 million sales in your business, your cash flow statement is literally your bank statement. You can equate your cash flow to your bank. But if you are running bigger business and you have debts, you have receivable, payables, all of these stuff coming in, then your cash flow needed a little combination between income statement and balance sheet. So I will kind of flow that out for you when I talk to you on the drawing board. So now stay with me and we're going to start the drawing board. All right. So this is the drawing board. So you see a drawing board, right? So on the drawing board, I want to draw your attention to a income statement. So what is income statement? Income statement is a piece of paper, right, folks? This is our income statement. And the people also call that profit and loss. Different names, but it says the same thing. So on the income statement, we have 3 body parts. 1, 2. I forgot to close my door when I got into the webinar, so you can hear a little bit of noise in the office, but it should not bother you too much. So in the income statement, we have 3 body parts. This part is the sales. This is the revenue you make. Some people call that revenue. And so basically, this is the money coming in. Money coming in. And this is also what I called credit. Remember, I was saying that income is a credit. From your bank statement standpoint, this is the money coming in. So you have your sales, money coming in. But this part is your cost of goods sold plus expenses. So these are all money goes out. And this is the debit part. So in this body of income statement, you got your income and you got your expense. So when you use the sales minus all your expenses, what you got? You actually got what? Profit. Right? You got profit. If you don't get profit, what you got? You got loss. That's just how the business is. So business owners are so quick to understand this. They go, oh, Ying, I understand that totally. And, income is here and expenses here and whatever left is profit. So what is this bottom piece does for us is the bigger the number is, the more taxes you pay, right? Very obvious. Sometimes you pay the taxes on your 1040 because the company is passed through. But sometimes the company is a C Corp and separate entities, it will pay taxes on its own, right? So the C Corp is the one that paying taxes on its own. This is the one that President Trump is working on lower the rate as we speak, right? So now let's talk about balance sheet. So we also have a balance sheet. Remember we talked about balance sheet is a picture, snapshot picture on December 31st of this year. But income statement, instead of not a picture, is what? Is video. It goes by a period of time. So we have this income statement from January to December. So now the balance sheet, to really put them together like one set of statement, if this one goes from January to December, we need the balance sheet is as of December 31st, 2024. And this one, of course, is 2024, right? So we need a balance sheet to be like this. So with that said, now what's in the balance sheet, folks? There's also 3 parts. That interesting? So there's also 3 parts. So the first part, what is the first part, folks? asset. Right? What's all in asset? You have your bank balance. What? You have your current asset, or you have a real fixed asset, right? It's all asset, right? So how do you get asset? Let's say you have a car. Let's say you have a car here. How do you get it in there? Didn't you spend money from your bank and bought a car, a real car? So you're actually reducing your bank. You're increasing your asset. Did you see? This transaction didn't go anywhere. It's actually stayed right inside of this box. Okay? So I just want to bring that to your attention. Because when you buy inventory, it's the same thing. When you buy inventory, you reduce your bank and you increase your inventory. You see, it didn't go anywhere. It stayed inside of balance sheet. What else is in the balance sheet? Liability. And what else? Equity. Equity, liability. So what the relationship between the three boxes? Just look at income statement. We got sales minus expense. We got our profit. We pay our taxes. So straightforward. On the balance sheet, you got your asset, and you got your liability, and you got your equity. And in reality, everything you own in life, you either have it or you borrow the money to have it. Am I true? Am I right on here? So it is liability plus equity equals to asset. So with that said, folks, you know that whatever you have in here, it is either you have it or you borrowed. So this part goes to here, this part goes to here. So there's no other ways to have your asset. There's no other ways you have the bank with money in there. You either made it or you borrowed it. Am I right? So with that said, and this is how these two sheets connects. These two sheets connects with a magic conclusion at the end of the year. So now on December, so let's say we got $100,000 profit. Then it will ring over to here and become the net income for the year. It will be your equity. Make sense? Because you made it. It's your equity. What about before? So every year you have retained earning. You already have many numbers. Sometimes you have losses. So they are already accumulated over here. So this will be what coming in every year, right over here. Every year. So the connection between these two sheets is linked by equity and the net profit. So now, let me say credit and debit. Now you are saying that, okay, I understand. So you got three parts, balance sheet and debit and credit. So the debit, this is a debit. Why is it debit? Because on asset, and these are the things that you own, you bought, you spent. You actually bought a car, you spent $50,000. So you reduce your bank balance by 50, you increase your asset by 50. So the asset from money standpoint is the money you spent, am I right? So we understood that as a debit. The liability from money standpoint means you borrowed money. So you got a cash deposit into the bank. The bank just gave you $500,000 loan. and you got that increase the bank, increase the liability. With that, liability is a credit. So liability plus equity, equity is a credit. So liability, equity together should make up the top part of your balance sheet. So now, the part 2, when we talk about it, we will understand what bank means by, oh, we don't want to loan you money anymore. You have too much debt. What do they mean? Because they're saying this is too big and this is too small. And you add these two together to equal to your asset. They think most the asset is actually on the loan. It's not your real stuff. That's why they say you're not a good borrower. We don't want to loan money to you. So we're going to talk in depth about that on the part 2. But right now, I want you to understand the relationship. So with this said, I want to draw a connection for you. I want to draw a connection for you. I want you to see it. I'm going to use a red color to draw this connection, okay? And I'm going to make this connection a little thicker for us, so that way, I get your attention. Now, I'm going to connect here to here. The reason I connect that, it has the same character. The money you borrowed or the money you made, they all have the same character. What is that? That is money to your bank account. Am I right? Whether you borrowed money or you made the money, it is all deposit to your bank account. So that is what I call the twin sisters. They're twin sisters. So when you look at sales, when you look at a bank deposit, it could be your sales. It also could be the money you borrowed. But of course, the sales has consequences because the more sales you have and the more taxes you might pay because your profit will go high, right? So it is constant, a question mark. What about your deposit? So is your bank deposit is the money you borrowed or is the money you made? So a good accountant to file your taxes would look at the liability and then look at your sales at the same time. That's what they are doing. Then what about the other way? What about here to here? So your asset and your expense need to be looked at the same. Look at it. Look at how that works. So you know that when we buy asset, you have a depreciation, right? Depreciation would reduce your asset value, but put that onto your expense. So you would have depreciation expense here that is coming from your asset. So that will lower your asset value and increase your expense. So if we really talk in journal entry standpoint, we would be debiting depreciation expense and credit accumulated depreciation. And this account is actually sitting right here. So that is where adjusting your balance sheet, adjusting your income statement, they are similar. So if you get into situation where you go, oh, my profit is so big, my profit is so high, and I need to reduce my profit. So what you are looking at is to see whether your asset could get lower. When you lower your asset, it will bump up your expense because these are the same thing, right? It's like a jigsaw things, and one is higher, one is lower. So I always tell my folks that, you know how you buy inventory? A lot of time our small business owner thinking that, oh, about inventory, so I should not have so much profit. No, inventory is asset. So the higher the inventory, the higher the taxes. Why do I say that? Because when you leave the money on balance sheet, you don't move them into cost of goods sold, they don't become expenses, so they don't reduce your sales, your profit will be higher. So you got your inventory high on balance sheet, just means your profit is high on your income statement. When your profit is high on income statement, it means your taxes will be more when you submit that to Uncle Sam. So with that said, you want to look at your asset, see how you can write it down to the income statement becoming expense, then your taxable income will be lower. This is where the understanding, we want to knock into that understanding for you, so you will never ever think that, oh, you know, I bought a lot of inventory, I'm really good. You're not good. You bought inventory, you basically just have the bank cash turned into inventory and it's sitting on your balance sheet. You're not doing anything. You're not really utilizing it. So what we tell our client is that to examine your asset and to reduce your profit by putting in expense, and examine your liability to reduce your income. Maybe some of those things is not your income, it's your liability. So with that said, that already give you some ideas like how important that balance sheet is, right? Now, I know I didn't mention about cash flow statement, but remember, cash flow statement obviously is another statement right here. And to go with these two, and the cash flow statement is literally adding this together. So you, in the cash flow statement, you literally just have these 4 boxes, and the credit goes with credit, debit goes with debit. And if your sales is $1 million and less, you just use your bank statement. Don't even bother with cash flow. Normally, when you go around submit your financial statement, people don't care about the cash flow as much as the balance sheet, because the cash flow changes every day. And it is more of operational measures rather than outsider looking at how you are running on your business at the end of the year. But balance sheet is a snapshot at the year end. It offers a lot of values to the investor. So if I'm the bank wanting to loan you money, I would look at your balance sheet to see how big is this one. And I don't want you to have anything. If I am a lender, you want me to loan you money, if you got here is 0, you are a good candidate. If your credit score is high, you for sure are going to get a loan. But then if it is otherwise, then people look at what you have, goes, man, you got asset, you got 50 vehicles, but 49 of them is on the loan, so you don't have any room to borrow any more money. Does the income statement do anything for you in that lending situation? Of course it does, because if the profit is very big, then your equity will be big. If your equity is big and your loan may not be super big, so it helps, because it will lower your loan to equity ratio, right? So make your overall health looks better, and you want your nominator to be smaller, so you want your loan to be small, and you want your equity to be big. So your ratio should be small, this is big, so you want that to be really, really low, like that, right? Of course, that may not happen, but this is a desired ratio. You know, the lender will loan you money. So with that said, I want to conclude today because all I want to give you is the structure. I want you to close your eyes. Remember, income statement comes 3 pieces. Balance sheet comes 3 pieces. Those 3 pieces, and there's twin sisters from the revenue to liability. There's twin brothers from asset to expense. So these are literally the same thing. So similar thing. They're twin brothers. That's why I call them twins, because they look alike. Okay. So these 4 are, helping each other. If they landed on your income statement, you pay less taxes, right? If they reduce income, they increase expense, you pay less taxes. And with that said, you know the connections. The last box of profit and also equity, this last 2 boxes, they are adopted sister and a brother. They're not twins, they don't look alike. But this one deposit into here every year. So your net profit goes into the equity, and the next year you go into equity again. The previous one will roll into retained earning. So that is how the balance sheet works. So I hope you learned one thing or two, and I am happy that to talk about the part 2 next Tuesday, same time. What I will do is I will tell you what IRS is looking at with these boxes. So what IRS is looking for liability, what IRS is looking for asset, and how is IRS going to calculate the profit. So we're going to use the financial statement to guide you on the practical matters when the government come around to look at your books and auditing you, and whether it's DOL, IRS, workforce, and whatever you name it, workers' comp, and we can talk about how that drives that audit. I will talk to you again next Tuesday this time, and that would be our time to talk about financial statement. I will see you again. Bye-bye.